Hey finance fan, welcome back to my channel. In today's video, I'm going to go over a portfolio suggestion from Twitter or X, whatever you want to call it. I know that I have been quick to basically pick apart bad financial advice on the internet and try to get you thinking about it in a different way. Well, I also want to be able to complement good advice when I see it. So let's dive into this portfolio suggestion, my thoughts around it, what I would change if anything, and give somebody credit where credit is due. So a gentleman on Twitter named Mark Palmer, this popped up on my Twitter feed, and he basically was tweeting that if he was 20 years old right now, here's what he would do in his investing portfolio. Of course, not financial advice, just, hypothetical information here. And the way that he broke this portfolio down was he said he would do 50% of the portfolio in VOO, V-O-O, which is an S&P 500 index fund. He would do 20% of the portfolio in QQQ, which is going to get you invested in the NASDAQ 100 index, which is very tech-heavy, tech-focused, one of the best performing indices that we've seen. VXUS is going to give you international stock exposure that is not including any US. It's mostly going to be Europe, Asia. Then he goes on to say that he would put 10% of the portfolio in individual stocks and 10% of the portfolio in Bitcoin. So let's dive into this and get into the nitty-gritty of my thoughts around each of these suggestions, maybe some things I would tweak or change. Overall, I have to say that this is solid advice for a 20-year-old. When you are young, you are probably going to be able to take on a lot more risk in your portfolio because you have a lot more human capital ahead of you, right? You have a lot more time in your life to work and earn back money if you end up losing money or something happens and with your financial life and it derails you, you still have a lot of time to make things up. So the bulk of this portfolio that he is hypothetically suggesting for a 20-something-year-old is in the S&P 500 index fund VOO. If I'm looking at investing in an S&P 500 index fund, there are three main ones. There's VOO, there's IVV, and there's SPY, SPY. I'm going to be going for VOO or IVV most likely. SPY has a little bit of a higher expense ratio, but it's still extraordinarily low. So the reason that I love VOO and just investing in an S&P 500 index fund in general is that there is a nice set of diversification across actual stock sectors. So these are the main sectors of the market. There are 11 of them. And it's also going to be US stocks. So these are going to be like the top 25 holdings. These are all really big names, big US stocks. But keep in mind that US companies have gone very international. So a lot of US companies, your Facebooks, your Snaps, your Microsofts, your Apples, your Teslas, a lot of these companies are counting on growth that comes from international exposure. So even though VOO is a US major, stock index fund, you are still in an indirect way getting exposure to these corporations that are doing business internationally. So that's a good thing. Now, for a 20-year-old, 50% of the portfolio being in VOO, I do want to say that I think that a young person could probably afford to have a little bit of a higher allocation to QQQ, which we'll get to next. So maybe shedding off some of this 50% and adding it, to QQQ for someone who's really young, I think wouldn't be the worst idea. The QQQ, let's get to that. So this is going to have a lot of the same top 10 holdings as VOO. The difference is going to be the allocations are going to be a little bit different. You can see that the top weightings in the QQQ ETF, they're going to be a little bit higher than the top weightings in the Vanguard S&P 500 index fund. So essentially, these companies have done really well. I mean, Microsoft, Apple, Nvidia, Amazon, Meta, these have been some great performing stocks on an individual basis. So if the holding weighting is a little bit higher in the QQQ, then obviously we're going to see that outperformance. Once you get past the top 10 holdings, you can see that the holdings start to get a little bit different here. And so that's another thing contributing to, the difference in performance between the two. So all in all, these two ETFs, VOO and QQQ, have very similar top 10 holdings, but the underlying holdings are very different. QQQ is a more concentrated ETF because it's only got about 101 positions in it, or 100 positions. The VOO ETF is going to have 500, plus positions. I think it's 505. The VOO ETF, the S&P 500, is going to give you more diversification, right? So QQQ is a little bit more of a concentrated diversification, as I like to call it. Now, with that said, we could also make the argument here, and although I generally like this advice, we could also make the argument here that since there is so much overlap here between VOO and QQQ, maybe instead of 70% between these two, maybe we shed off a little bit of the allocation of that 70% and move it over into some of these other things. So maybe instead of a 70% allocation of VOO and QQQ, we take 15% of that and kind of spread it across the other things in this portfolio, like the international stocks, the BTC, and the individual stocks as well. So you could kind of take that and spread it between those to adjust the portfolio a little bit. And I don't hate that idea. That moves us over to international stocks. VXUS is one of my faves for getting that international exposure. If we look at the allocation, we can see that most of the allocation is going to be in Europe and Asia. There's a little bit of America in here, but this is mostly going to be Europe and Asia in here. This is also going to get you a little bit of exposure to international mid and small caps. So that's really giving you kind of that full international exposure to equities. Keep in mind, VOO and QQQ are not going to have that mid cap, small cap exposure so much. Those are more so going to be your larger corporations. So if I did have to give a critique there, I would say maybe we can get more small mid-cap exposure into the portfolio, especially for a young person. Then there is the 10% of the portfolio in individual stocks. Now, I want to preface this by saying when we are picking individual stocks and putting them in a portfolio, we want to focus on high quality. Unless you are a master stock picker, you've gone through, the research, you know what you're doing, you're digging through 10Qs and 10Ks and, all the SEC filings, and you're reading press releases, and you're really doing a lot of research. If that's not you, you need to be careful with the stock picking side and make sure that you are focusing more on high quality stocks, because there's less room for error, so to speak. Not financial advice for you, but for myself, I actually practice investing with a core and satellite strategy, meaning my core portfolio is my passive index funds, and the satellite of my portfolio is an individual stock portfolio. So I'm picking individual stocks. So I do like the fact that somebody is suggesting, hey, you can still have mostly passive index funds, but you can also keep some individual stock positions, when most people are absolutely anti-individual stock positions in their portfolio. I like to think that there's a happy medium here, and depends on your risk tolerance, but I like the idea. So I applaud this person for even considering this. I actually created a model core and satellite portfolio in YCharts, and I'm going to actually show you the results of this. Just like Mark suggested, I had created a core and satellite portfolio with 10% attributed to Apple, Facebook, Amazon, and then 90% just in your basic S&P 500 index fund. And then we're comparing that to an 80-20 stock bond portfolio and just the basic, S&P 500 index fund, the SPY. You could use VIEW here, you could use IVV, doesn't matter. And the core and satellite portfolio does outperform both SPY and an 80-20 portfolio in this case. This is something that I talk about a lot because I think that people can miss the mark pretty easily on this and be quick to just not use individual stocks in their portfolio because that's what everybody on, financial social media told them to do. And the fact of the matter is there is value that individual stocks can add to your portfolio. And this is, where the rubber meets the road here. This is exactly what I said earlier. They need to be established, proven companies and not a penny stock or a major gamble. If you've got the stock picking skills to go deeper and to look at riskier stocks, that's fine, but just make sure that you're not out of your league. And then lastly, the suggestion of 10% to Bitcoin. Now, I agree with this, especially for a young person. In fact, for a young person in their 20s, I wouldn't be opposed if somebody came to me and they had a larger than 10% position of their portfolio in Bitcoin. Because when you have an asset like Bitcoin that's really proven to be the best performing asset that we've seen, it does have a lot of volatility. But for somebody that's very young, I think that the prospects of Bitcoin returns look pretty good for someone that can hang on and hold that asset for a while. So I like the 10% going to Bitcoin. A lot of advisors out there will tell you that 10% is too high. Many may stick to like 2 to 5%. I just think for most people that follow me, most people that I talk to, I deal with a lot of traders and investors, that are active in the markets. 10% is probably going to be too low for them. So, but that's just what the people that I'm used to kind of working with. But I like this. Overall, I just think that this is generally good, solid, hypothetical, advice. Sounds to me like, Mark knows what he's doing. He's not shaming one investment style over the other. He's actually allowing these investing styles and the different assets to work together in a portfolio. And I kind of use this saying, you can have it all. You can invest passively. You can invest in crypto safely. You can pick individual stocks safely as well. You can have it all in your portfolio. So hats off to Mark. I like this advice. Wanted to give my thoughts on each, add a little more context. If you like this video, make sure to hit the like button for me, please. I really appreciate it. Subscribe if you're not subscribed. If you liked this kind of content and you want me to review your portfolio on YouTube, you can email me, support@shetalksfinance.com. You can also send me a DM on Twitter or Instagram @shetalksfinance and send me your portfolio, and we'll keep the fun going. All right, until next time.